The SEC is about to let crypto exchanges trade Apple and Amazon as tokens, and the details of how this is going to happen are absolutely astounding. We're not only getting pushback from Wall Street, but also some pushback from the tokenization industry. We're going to unpack that and everything else happening today in the news right now on the Daily Wolf. Let's go. What is up, everybody? Welcome to the Daily Wolf on Yahoo Finance. I'm your host, Scott Melker, also known as the Wolf of all streets. You can find me at Scott Melker on all of your beloved social platforms. You can watch me on YouTube in the morning. You can read my newsletter every day. There is a lot going on and a lot of content for you to consume. Speaking of content to consume, we have a few stories that are really impactful for markets that we're going to unpack today. Now, I'm going to be honest, this first story, I'm not really sure how I feel about it. I know that we make the pitch here that will separate the signal from the noise. This is definitely signal. The question is whether we should be excited or very weary of what's happening. Of course, that's the biggest story this week, which is the SEC said to ready plan for trading crypto versions of stocks. This is from Bloomberg Law. This was broken on Monday, and I don't really feel like the media is covering this correctly or understands how deep the implications are. So the headline itself, the SEC wants your Apple stock on chain, is not mind-blowing, right? We've been talking about, since this show existed and long before, about the inevitable tokenization of everything. Larry Fink and BlackRock have been talking about it for years. Chairman Atkins at the SEC came in and talked about Project Crypto and said that by the end of 2026, everything would be trading on blockchain rails. The DTCC, who settles 4.7 quadrillion in volume a year of securities, said that they're moving to blockchain rails after getting a no action letter from the SEC. That is not the story here, even though that is what the headlines are telling you. The story here is that the SEC is proposing an innovation exemption, potentially by the end of this week, that would allow for the tokenization of stocks without permission from the issuer. So let's start from the beginning. First, there's basically two ways that you can tokenize stocks. One is the vanilla way that Wall Street loves. It's issuer-approved tokenization. We'll call this the clean model. Let's keep using Apple as an example. So Apple authorizes a transfer agent. That transfer agent is regulated. The shares are officially mirrored on-chain. Corporate actions are integrated, like voting, dividends, the cap table. All of those things are very transparent, basically a one-for-one. So this is blockchain modernization of existing equity infrastructure. This is what the DTCC and before the industry have been talking about, basically using blockchain as plumbing to increase speed and to reduce fees and basically a better technology for the rails. That's not what the SEC is proposing here. So this is number two, which is very contentious. Synthetic or wrapped tokenization without issuer consent. So in this case, let's say a third party, like me, buys real shares, custody them, myself, I guess, and then issues blockchain tokens representing claims on those shares. So the company, Apple in this case, never approves it, may not even know it exists, and has no relationship to the token holders. Now, you know, if you're a shareholder of a company, if you have an E-Trade Morgan Stanley account, every once in a while you get an email that says, you know, would you like to vote on these dividends, or they need your voice? You would get none of that in this case. You would not have the voting rights, leaving questions as to what happens when there's a split or a dividend or a vote. So this is a lot closer to ADRs, CFDs, and of course ETFs. So interestingly, ETFs do not require the issuer of a security to approve to put it in an ETF wrapper. And that's what the SEC is sort of pointing towards here. Basically saying if investor protections already exist, the issuer permission may not be legally required. And that there is precedent for that. You can understand intellectually how they're saying that because stocks already trade freely in secondary markets. There's derivatives. As I said, there's ETFs. So the core legal question really here becomes, is tokenization creating a new security, or is it merely a new technological wrapper around an existing security? But think about what this means before we get into the actual nuance. This means you will have 24/7, 365-day-a-year trading of stocks. This will be on blockchain rails, largely on decentralized exchanges that are unregulated, don't have KYC and AML. They'll be available to everyone, everywhere in the world, all the time, not just US investors, and they can be wrapped and rewrapped and used in DeFi that's where it becomes very sticky. So first of all, Coinbase, Robinhood, OKX, Kraken already has X stocks. They're all building for this. They want to be all-in-one everything apps for people who want to trade everything. But it's not surprising we have pushback from Wall Street. What I found surprising, but not when I dig into it, is how much pushback there's been from inside the industry. So this is from Brett Redfern, the president of Securitize, which runs BlackRock's Biddle and others, right? This is his quote. If third parties can tokenize Apple or Amazon without the issuer at the table, there's no theoretical limit on how many wrappers of the same company exist at once. Now, I told you a story last week about how Anthropic, which is a private company, was already pushing back on secondary shares, saying that they may be completely void. A public company can't do that, right? Anthropic can do that, but Apple can't. So I went to my crack research team, and I said, what could possibly go wrong? And by crack research team, I mean Claude. It's Anthropic. And I said it, and I'm going to tell you exactly. That's all I said. What could possibly go wrong? Number one, infinite synthetic supply. Anyone can mint Apple tokens, and 10 different platforms could each have their own Apple token, none of them officially Apple. Price discovery collapses because there's no single source of truth. Two, they get used as DeFi collateral. I've told you enough stories about the problems with DeFi collateral. Number three, a DPEG event. Real Apple stock has a corporate action like a split, buyback, dividend, or M&A. What happens when that is not reflected in the tokenized stock? They start to trade at different prices, and the token depegs, which of course can lead to cascading liquidations. That's 4. 5, the contagion crosses into real markets. What if on the weekend one of these things happen and Apple stock tokenized on one platform drops massively and that platform actually has size? Will the stock crash behind it on Monday when the market is open? And of course, the biggest one, nobody's responsible. Apple didn't issue the token. Tokenization platform that minted it claims no liability, yada, 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 yada. So this is the single sentence version that Claude told me to read on the show. Unauthorized tokenization turns every public company into a potential Terra Luna. With the contagion path running through DeFi lending markets and back into real equity prices, and nobody has a legal duty to make holders whole. That's why Securitize is screaming about this. They want one issuer at the table, with one canonical token, one source of truth, one entity legally accountable. Without that, maybe we're building a system here designed to systematically detonate. So listen, I obviously believe in deregulation. I believe that people should be able to trade whatever they want. It's their own money. But I'm wondering what the secondary consequences of allowing this could possibly be if the SEC is just wrapped up right now in figuring out what the legal definition of these things should be. We've proven that DeFi is not entirely secure. When you add AI and hacks into the equation, it could get very ugly if the worst version of this is allowed. Like I said, I kind of sit on the fence on this one. Of course, we need to see the actual innovation exemption in writing, which could happen as soon as the end of this week. So this is largely based on conjecture, but that is what is projected to be stated. Now, a not dissimilar story that is our second story of the day is this one. Wall Street pushes for Hyperliquid regulation. This is from Bloomberg. Now, this is from the CME Group and ICE, and this was on Friday. They lobbied the CFTC and Capitol Hill to crack down on Hyperliquid. They were voicing concerns about oil market manipulation and sanctions evasion, none of which anybody has presented any proof of. But this, once again, goes back to the initial point. This is 24/7, 365 trading with leverage on a decentralized platform where they don't have know your customer rules that can happen all the time. So this was forgettable for regulators and for the New York Stock Exchange and the CME when it was just a bunch of crypto degenerates trading against each other on the weekends on their favorite meme coins and crypto assets. But it jumped the shark and became a very legitimate trading platform as we've seen these massive moves in silver and gold. As altcoins became less interesting, the traders there started to trade contracts on silver and gold and then, of course, on oil. So now you have oil perps trading, doing $700 million a day in volume on Hyperliquid, and that can happen on a weekend when other markets are closed. This is a story of the incumbents panicking because their lunch is about to be eaten by crypto and there's nothing that they can do about it. What they need to do in this case is get 24/7, 365 and provide the massive liquidity that would compete with a Hyperliquid. But really, really interesting story and nuance here. Now, the next story is one I'm going to put together for you just to show you a systemic problem that we obviously have. So the first story is not a problem. I find this great. This is from the Fed itself. Cryptocurrency use. We had it at a peak of 12% of Americans using cryptocurrency in 2021, went down to 10, 7, 8, now rising back to 10, and by all data, will surpass those 2022 numbers very soon, and 2021 numbers. Now, interestingly, they define use as investing. So almost, 90% of this is people who are investing or holding crypto assets. So the first part of the story that I want you to remember is that we're seeing an uptick in the usage of cryptocurrency. Now let's talk about why. First, this is the total debt balance of U.S. households. Now remember, I show you all the time the debt clock where the United States debt is absolutely out of control and rising almost $40 trillion. Well, that obviously trickles down. Now we're at $18.8 trillion for household debt. That is a record high. Then you drill into delinquencies, 90 days delinquent. We have credit cards, 90 plus days delinquent at 13%. This is the highest in 23 years of data, higher than the 2008 financial crisis. Student loan debt, 90 plus delinquent, 10.3%. 2.6 million student loan borrowers were referred to the Education Default Resolution Group in Q1 alone. So very clear that the consumer, and especially the student who's paying off a loan, are in big trouble right now because they've taken on unsustainable debt. That may sound familiar to what I told you about the government. Well, how about the institutions that they took this debt on to attend? This went wildly viral. Clemson is $1.5 billion in debt. Syracuse is closing or pausing 93 programs. UNC Chapel Hill plans to cut spending by $89 million, yada, yada, yada. You can read that for yourself. The universities are in massive trouble, and it's from the same exact three-step pattern that we saw from the government and from the individuals. One, cheap money makes it irresistible to overborrow. People take on debt when money is cheap. They feel like the party is going to keep going on because that's number two in the step. Everyone assumes that cheap money is permanent. You take on all these debts, you hire all these people, you expand, you buy a bigger house, you take on more credit card debt because you think that the rates will never change. And those do. And then reality breaks the assumption and the debt outlives the assumptions. And that's what we have happening right now, right? And all of that combined for the universities with the fact that fertility rates peaked in 2007 and have dropped. Well, do the math. Go back to 2007. Those kids who were born then are just going to college now. Makes a lot of sense when you put that story together. But the real story here is that everybody got addicted to debt. And everybody is now getting outpaced by inflation. And that's the reason I did my entire rant on Bitcoin in the past. Now, yes, we've only seen a minor uptick in the use of cryptocurrency in American households. That's from the Fed. I think it's actually larger. But the story there is more people are starting to realize and exit the matrix and start to buy Bitcoin and use crypto because they realize that the system that they're trapped in, both at the national level, institutional level, and individual level, is imploding. Now, I have one last story to tell you because it ties right back to the DeFi problems that we talked about before. Echo Protocol's eBTC exploited for $77 million in admin key compromise. I don't know what Echo Protocol is. This is probably the 15th or 20th hack of a platform I've never heard of, and I'm in crypto 24/7, 365. That should show you just how degenerate the crypto world is. But the story is not this hack. This was actually only less than $1 million were actually lost. The story is that this is the 14th major DeFi exploit in May alone. Look at the calendar. It's May 19th. That means there were 5 days this month that there wasn't a DeFi exploit. Just the past few days, May 15th, Thorchain for $10.8 million. May 18th, Varus Ethereum Bridge for $11.58 million. What the hell is that? I've never heard of that. You've never heard of that. You don't know what that is. And here you go, Echo, 76.7 million minted, 816K extracted, 328.6 million total bridge attacks in 2026. So what happens, pray tell, when Apple and Amazon stocks are wrapped for the 10th time being rehypothecated and looped for yield over and over again, and they end up as the underlying collateral on one of these nonsense platforms that you've never heard of, and it blows up? There's incredible systemic risk to what's being proposed here. DeFi is clearly not ready for prime time, and I have my concerns about sending everything into DeFi. That's all I've got for you today. I'll be back tomorrow for the next Daily Wolf. Peace.